Good morning, everybody, and happy Thursday. It's a beautiful day here in Irvine, California, and I wanted to jump on today to talk about IRC Section 199A, the Qualified Business Income Deduction, or as it's being referred to in the media, the 20% pass-through entity deduction. This comes as part of the Trump tax cuts and is one of the biggest tax breaks for you small business owners and real estate investors who most often operate as sole proprietorships, partnerships, S corporations, or LLCs taxed as partnership or S corps. And this is definitely something you'll want to take advantage of if you qualify. Essentially what this IRC section does is it gives you an extra deduction, or as some of you like to refer to them, an extra write-off on your individual tax return. And it's equal to as much as 20% of your pass-through income. So if your business nets 100K, you can qualify for a 20K deduction, and you'd only pay tax on 80K of that 100K that was earned. Now, that's an oversimplification because you're likely to have other sources of income and deduction, but you kind of get the picture. Of course, nothing is ever easy when it comes to the government, and also the tax code is used as a tool to incentivize the public. So Congress wrote into the IRC code a bunch of rules, factors, definitions. And so this is going to bring me to the point of today's video, which is I'm going to break this down for you, simplify it, and give you the best information per the proposed regulations, which were released 2 weeks ago. So effectively, you're going to fall into one of three categories, and depending on what business you're in, those income categories will affect you in a variety of different ways. So category one. You have taxable income of less than $315,000, married filing joint, or $157,500, not married filing joint. Taxable income is calculated at the individual level, after all your deductions. If you fall in this group and your income is coming from a domestic, trade, or business, you're fine. You get the full deduction, 20%, you're welcome. You still have to prepare the returns properly, or have a professional do it, and it has to be prepared correctly at the entity level as well as the individual level, but there you go. Category two, this is where it starts to get really complicated. Your taxable income is between $315,000 and $415,000, married filing joint, or $157,500 and $207,500, not married filing joint. The IRC says you'll only get the full deduction if you employ people or have qualifying property that is currently depreciating on your tax return. And that's stuff like equipment, furniture, real estate, etc. The max deduction cannot be more than 50% of the sum of all your W-2 wages that are paid to all your employees, or 25% of those W-2 wages plus 2.5% of the unadjusted basis of qualifying property. Did I mention this was complex? As an example, your business nets 100K and you only paid 30K worth of wages. 50% of 30K is $15,000. You wouldn't qualify for the full 20K deduction under criteria 1. So in order to get the full deduction under criteria 2, you would then need qualified property with an unadjusted basis of 500K. 500K times 2.5%, 12,500. Add in 25% of 30K, that's 7,500, and boom, you're at 20K. You get the full deduction. So in case I lost you, remember this is if your income is between $315,000 and $415,000, married filing joint, or $157,500 and $207,500, not married filing joint. And these rules phase in, so you'll get some of the deduction even if you don't fall under the aforementioned criteria 1 or 2 if you're in there. So if you're in a specified service, trade, or business, SSTB for short, it gets a little hairier because you begin to phase yourself out completely out of the deduction, regardless of if you meet that wage or qualifying property criteria. Specified service, trade, or businesses include accountants, lawyers, health professionals such as dentists and physicians, professional athletes, and anyone else whose main asset of the business is the reputation or skill of one or more of its employees or owners. Ouch! Architects, engineers, and realtors are not considered SSTBs for the purpose of this deduction. Furthermore, the IRS drafted an anti-abuse opinion for you creative attorneys and accountants out there. If there is a business that has 50% common ownership with a specified service, trade, or business, and more than 80% of its revenue is coming from a related business, the business in question will also be treated as an SSTB for purposes of this deduction. IRS went on to say that they're going to address co-ops in future proposed regulations and opinions. No time to explain really co-ops today. We're running out of time as it is. Finally, we come to category 3. Your taxable income is above $415,500 married filing joint, or $207,500 not married filing joint. You're an SSTB, you don't get a deduction at all. And any other business, you have that full force wage and unadjusted basis criteria. Okay. Now I'm going to try and tie up some of the loose ends, questions that you might be having. If you own multiple businesses, maybe one is an SSTB, another one's not an SSTB. Well, each individual activity is going to be based on its, going to be judged on its own merits, and will qualify, may or may not qualify. Next, you got people in the real estate industry. Rental real estate, is that a trade or business? Well, you got to look at IRC Section 162. It's a little vague, but in short, the answer is rental activity is probably a qualifying trade or business for purposes of this deduction, even if you only have one rental property and even if you have an agent managing it. But probably not if it's really passive or if it's a triple net property. So sorry to be a little vague today, but I can't really give a blanket answer. Well, that's all I got for today. I trust the video was informative. I know tax is a dry topic, but hey, I like it. And if you have any questions, feel free to drop them in the comment section below, and I'll attempt to respond. And don't forget to like, share, subscribe, wherever you are. Thanks again.